IRAs and 401k programs are very, very popular retirement plans. Between 10 and 20% of your clients will be involved in one of these plans in one way or another. If they are already retired, they will be receiving benefits from them. If not, they'll be making payments to them in order to reduce their taxable income. Distributions from either of these plans are taxed the same way as retirement plans and annuity payments. However, as payments into the plans are not taxable, any withdrawal from them will be taxable. This is different for Roth IRAs, which I'll discuss in a moment. If the taxpayer withdraws from an IRA or 401k plan before he or she is 59 and a half, it is an early distribution and therefore likely subject to a 10% tax penalty if it's not rolled over into a comparable plan within 60 days. Imagine that your longtime 35-year-old client, Kathy, comes in and tells you, guess what? You know that company I worked for the last 10 years? I don't work there anymore. And I took my 401k money out, so I have this 1099-R. What do I do with it? So what do you want to know first? You need to know when she withdrew the money. If she took it out within the last 60 days, what will be your advice to her? Of course, you'll suggest that she roll it into a comparable plan to keep from paying taxes and penalties on it. If, on the other hand, she withdrew it last June or already spent it, then the early distribution will likely be ordinary income to her, and there will be an additional 10% penalty to pay. It's an expensive mistake, but sometimes a taxpayer cannot help it. Recently, Congress created a new type of IRA called a Roth IRA. Whereas conventional IRAs are not included in taxable income when paid, Roth IRAs are. The benefit of the Roth is that the withdrawals are not taxable, including any interest earned. We had a very interesting situation occur recently. A young woman came in and said, I left my job, but I took care of everything regarding my IRA. We asked, what did you do? She explained that she contacted her brother-in-law's friend, who was a broker, and that he rolled her distribution into an IRA. So far, everything is sounding okay. Then we asked what type of IRA, to which she answered, a Roth IRA. Do you see a problem? She is taking a conventional IRA for which no taxes have been paid on the contributions and rolling it into a Roth IRA for which contributions are taxable. Her 1099-R proved our fears to be correct. We called the broker and explained the problem. He swore it was all legitimate, that there would be no tax. We explained that we had a 1099-R from the company he placed the funds with that showed the transaction to be taxable. He said he would get back to us and call us moments later to tell us he was wrong. So he went through the work to reclassify the transaction into a conventional IRA and prepared a new 1099-R. If she had not reclassified the transfer, she would have owed a lot of taxes. Traditional IRAs become income when you draw from them. If you are over the age of 59 and a half, you do not have to worry about the 10% penalty. For the first 11 years, withdrawals are optional. At age 70 and a half, a person must start to draw from a traditional IRA. Nevertheless, I suggest that they not wait beyond their 70th birthday to start drawing. If they wait the additional 6 months in most cases, they'll have to draw 2 annual payments that year, thereby elevating their income considerably and putting them in a higher tax bracket. For example, imagine that Paul turned 70 in December. If he waited until he was 70 and a half before taking his first annual payment, he will have to take a second annual payment in December when he reaches 71 years old. Instead, Paul should take a payment on his 70th birthday so that next year he only has one payment. Publication 590 contains information on how much a person must withdraw after a 70th birthday. When do we have to draw from a Roth IRA? Never. Don't have to. Roth IRA contributions are taxable and all gain is tax-free. The taxpayer can draw from a Roth after he or she is 59 and a half and after at least 5 years from the date of the first contribution to the Roth. However, unlike the traditional IRA, you do not have to draw it out, ever. In some cases, a taxpayer can leave their 401k and even employee savings plans with the employer even after they leave employment. However, many employers require employees to sign a contract stating that if they leave the company, they must remove their retirement funds within 90 days. If that's the case, after 90 days, they're going to strike a check and send it to the taxpayer. This is an example of a lump sum distribution. Or another example of a lump sum distribution occurs when an employee leaves his or her place of business where they have a pension, and they decide to take a cash payout instead of taking the employer pension over time. Regardless of the reason for the distribution, it's best to roll it over into an IRA within the 60-day period. Remember that if the taxpayer does not roll it over within 60 days, he or she may be assessed an additional 10% penalty. A few moments ago, I mentioned that contributions to a 401k or traditional IRA are deductible, while contributions to a Roth IRA are not. Inversely, the withdrawals from a 401k and traditional IRA are taxable, while withdrawals from a Roth IRA are not. In essence, the money will be taxed either when it is withdrawn or when it is contributed, depending upon the plan. One of the more common questions I get is which of the two are better? To answer that question, you have to consider two variables. First is how much time the account will have to grow before withdrawals begin, and second, upon retirement, will the taxpayer be in a higher or lower tax bracket than they are now? Although it's a huge generalization, the quick and dirty answer is based on the age of the taxpayer when they begin contributing to the program. If the taxpayer is under 40 years old, the Roth is generally the better choice because they will have a few decades of untaxed earnings in the account when they are ready to withdraw. Furthermore, their tax rate is likely less than or equal to what it will be when they retire. Certainly, without a functioning crystal ball, there is no way to know at this point if either of these assumptions is right. So make sure you disclaim any suggestions you give and let them know that it is totally their decision as to which plan they should choose.